Welcome to part 4 of the Trading 101 series. In this part, I'm going to be talking to you about what is a stock. Remember to like, subscribe, share, all that good stuff. And I've got Facebook, Twitter, and Instagram at the Not Trade on all social media platforms. Also, check the description below for all the other stuff. I'm not going to go through that every single time. You know the deal by now if you watch the first 3 parts. Alright, so what is a stock? So a stock can be referred to as a share or an equity, but the equity is an overarching term that means a lot of things. It's a type of security that signifies a proportion of ownership in the issued corporation. So that's why it's referred to sometimes as a share, because it's a portion of that company. This entitles the stockholder that proportion of the corporation's assets and earnings. Now there's 3 main ways of segmenting stocks. You can do that by size, by the sector they're in, or by comparing them as to whether they're defensive or cyclical. And I'm going to go through that in the next couple of slides. So a company can be segmented by market capitalization. Now market capitalization is the number of shares issued multiplied by the price per share. Now this gives you the value of the company as a whole. So large cap stocks are anything over $10 billion in value. They're often less risky to invest in and offer less growth potential, but can pay good dividends. Mid cap is anything between $2 billion and $10 billion, and the small cap stock is anything less than $2 billion. These stocks are more risky but have higher growth potential. Now stocks can also be segmented by industry sector. The Global Industry Classification Standard, also known as GICS, is the primary financial industry standard for defining sector classifications. Now the following 11 are internationally recognized industry sectors. You have the energy sector, which is companies related to the production of energy such as oil and gas companies like Chevron. Materials refers to companies involved in the discovery, development and process of raw materials, such as mining companies like Rio Tinto. Industrial companies are companies involved in producing goods used in construction and manufacturing, such as Stanley Black & Decker. Consumer discretionary are companies producing non-essential goods and services, such as cars and luxury goods and durable goods, such as Ford Motors, for example. And consumer staples are companies that produce essential products like food, beverages, household goods. One example is Kellogg's. Healthcare companies provide medical services, manufacture medical equipment or drugs, and provide medical insurance, or otherwise facilitate the provision of healthcare to patients. Financial companies are firms and institutions that provide financial services to commercial and retail customers. This sector provides a broad range of industries, including investment companies, insurance companies, real estate firms, and banks, such as Wells Fargo's, for example. And the IT sector are companies that produce technology-based goods and services, such as Advanced Micro Device, ticker symbol AMD. The telecom services are companies that make communication possible on a global scale through the internet, through airwaves or cables, wired or wireless, such as T-Mobile. Utilities are companies that provide basic amenities, such as water, sewage services, electricity, dams, and natural gas. Such as the UK's Natural Grid, which is on the London Stock Exchange. And then we have real estates. These are companies engaged in real estate development and operation. It also includes companies offering real estate related services and equity real estate investment trusts, also known as REITs, such as Land Securities, which is also on the London Stock Exchange. If you want to learn more about each of these sectors, I've made a separate video on each sector where I delve deeper into their risk level and growth potential. And then you have defensive versus cyclical stocks. The stock market is often ebbing and flowing between recession and recovery as a part of its natural economic cycles. But this is where we come to defensive stocks. These are stocks and companies that aren't affected by the economic cycle and provide a stable earnings regardless of the market performance. So they perform above market average during times of recession and below market average during economic booms. You can find a lot of defensive stocks in sectors such as the utility sector, consumer staples, healthcare, and the housing market. And the thing these have in common is that these are products that are necessities regardless of your economic situation. You will always need food, healthcare, shelter, and electricity. So just think about what are necessities, and those are normally stocks that are defensive stocks. And then you have cyclical stocks, and as the name denotes, price is affected by macroeconomics. So cyclical stocks peak and trough in line with the economic cycle, booms and busts. They're much riskier than defensive stocks, but provide higher return on investment if entry is timed right. So when you think of cyclical stocks, you're talking about things like airline tickets, hotels, restaurants, luxury brands, cars, anything that is not a necessity and would go quickly in times of recession when money is tight.